Good morning and welcome to this Monday, August 30th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, I'm back, so that's a good thing. I feel a lot better. I want to thank everybody for patience and all last week and all the well wishes. It was a rough week for sure, but I got a little bounce in my step today. Probably feel a lot better than I sound. I'm kind of, if anyone out there had sinus infections before, you may know what I'm talking about, but you get to a point where you start sounding a whole lot worse and start feeling a whole lot better. And that's the stage I'm in right now. But really appreciate the time off from last week. Thanks to John for stepping in, I think on Thursday. I will say that I probably spent less time last week looking at the stock market than I have in a long, long time. But I do feel a lot better starting this week. And so I think we're ready to get back at it. Excuse me, and I probably will have to pause from time to time for a cough here or there, but otherwise I should be pretty good. I do want to welcome those of you who are new to Earnings Beats. Take you over to our homepage here in 1 second. If you do scroll down, you'll see that we do have a free Earnings Beats Digest newsletter. I wrote an article in Chart Watchers over the weekend talking about a potential bottom in a software stock. And I hinted in there that I'd be revealing another one in our Earnings Beats Digest, which I did earlier today. But this is a newsletter. It's free, no credit card required. You can unsubscribe at any time. It's published 3 times a week, Mondays, Wednesdays, and Fridays. All you need to do is just come into our homepage, scroll down to this area, and then simply type in your name, email address, hit that subscribe button. Again, no credit card required. You can unsubscribe anytime. Not gonna hurt my feelings or anything. But we'd love to have you. It's I think very educational in nature. We'll provide you a trading candidate from time to time if you so desire. But I think it's a great way to learn a little bit more about the way we approach the stock market. And I think hopefully will improve the way you look at the market and hopefully improve your results as well. If you'd like to try our service, we do have a no-cost trial. So you can click on this button here and that will get you started. You can kind of take a look at the different things that we offer. I think we have a lot in our service, and certain things appeal to different folks. So you might be somebody who's more, maybe you're longer term. You don't really care about the day-to-day stuff. You just want to be kind of guided along anything that, may be sticking out about the market, having long-term issues ahead, something like that. Then you might appreciate the guidance, the daily market report that we do. Otherwise, though, if you're a trader and you're more short-term inclined, I think you'll find a lot of great research products that will help in some of your trading. But anyhow, you can go through, take a look at this. If you're still interested, click on that join today, and then it'll take you to a page where you can simply sign up. 30 days, no cost whatsoever. If you do sign up and you enjoy the service, I would suggest before the 30-day trial, make sure you reach out to us for our annual special. You can just write to us at support@earningsbeats.com. That's probably the easiest way. Anytime you have a question, just send an email into support@earningsbeats.com. But the annual will save you probably 50% over the regular monthly rate. If you don't do anything and you just start getting charged monthly, it's going to be $147. Your annual is going to be $997. So that immediately will cut off probably about 40%. And then usually when you sign up initially, we'll give you a free month as well. So that'll be an extra bonus month. Anyhow, just want to kind of update you all on that, especially if you're new. Let's get over and take a look at what happened on Friday. Honestly, some of this is going to be fairly new to me. I really did not look at the market much from Wednesday through Friday. I did look over the weekend, so I've kind of gotten caught up. Market continues to power ahead. Dow Jones Industrial Average on Friday up 243 points, S&P 500 up 39, NASDAQ up 183. Look at the NASDAQ now up over that 15,000 level. S&P finally closed over 4,500. I made a comment last week, but there's a lot of folks that always look at the market negatively, and they're always looking for something to bring the market down. And nothing's working. The market just keeps going higher. This is a secular bull market at work. Can't stress that enough. Look at the mid caps. Remember, talked last week, been talking for weeks about mid caps and small caps underperforming. They were sideways consolidating. They were not in a bear market. Money rotated away from them. We've seen this throughout the market for the last year. The rotation has been crazy. And it's like, for a while back when the yields were rising, maybe back into January or something, February, mid cap, small caps were really doing well. And then as soon as money started moving back into bonds, that seems to be about the time that money moved away from mid caps and small caps. And we've been doing this sideways stuff. Last week, we saw the yield start to rise again. All of a sudden, mid caps, small caps come back to life. We're at 2-month high on the small caps, multi-month high on the mid caps, not far from an all-time high. Great action. Also notice on the small caps, look at that AD line. If there was one concern, it was the AD line on small caps. That's beginning to rectify itself. So I'm seeing nothing but bullish action in the market. And I know I actually had an email come in. I think it was late last week, maybe over the weekend, but it was asking about the seasonality and the fact that, this time of the year tends to be weak. How do you reconcile historical weakness with a market that just keeps going higher? And what I always say is seasonality is always important to me, but it's always secondary. The seasonality, if you look back and you really want to study when the market goes haywire in the month of September, if you go back and you look, it's going to be in a lot of those months within the secular bear market cycle. So think back to that August, September period back in 2008 in the financial crisis. I mean, I remember September 22nd to, I believe it was around October 10th. And I've got a funny story, the reason I remember that. But those 3 weeks, I think the S&P 500 went down 25% from September 22nd to October 10th of 2008. The reason I remember that is that I was bearish. I mean, I was definitely bearish. I'd moved to cash. I think I'd moved completely to cash right around the 22nd. It might have been a little before. I don't remember exactly when. And I might have even been trading. I know back then I was trading the inverse juiced ETFs. So you actually made money when the market went down. I don't like to do that, but I will in a bear market, a secular bear market. Anyhow, so I thought I was completely set. And I remember going out to my mailbox, and it was on October 10th of 2008. And I remember getting out the college fund, the statements that they send you at the end of each quarter, because I had college funds set up for my kids. And when I pulled them out of the mailbox, I mean, it just hit me. I probably went white as a ghost, because I remember seeing the statement, through the little window envelope. And I was like, oh my gosh, I didn't take the money out of the kids' funds, investment funds, the Maryland College Investment Plan. And it took me a while just to open it, because I knew not only was this statement going to be really bad, but this statement was as of September 30th. So it had been 10 days since September 30th that the market just kept going down. So, I always joke to the kids, I was like, that was the 3-week period when your college went from Stanford to a local community school. You can laugh about that stuff now, but back then it was not a laughing matter. I remember not being very happy at all when I went to the mailbox, because it was something I didn't manage. So it was money that was just kind of not something I was thinking about. And so, yeah, I'll never forget that period, September. And I if I didn't hit the exact dates, I know I'm pretty close. It was like September 22nd to October 10th. But anyhow, I digress. Moving on, looking at the sectors here, you can see energy bouncing back. And a week ago, I wrote an article. I was basically saying, get the heck out of a couple of areas. within materials, which I think was aluminum and steel. And the timing of that article probably wasn't the best because we did have a really nice bounce back in energy and in materials. You can see materials over here. But my signals are still not changing. They're still telling me the same thing. I don't want to be in these two areas. And I'll explain a little bit about that in just a minute. But energy did have a really good Friday, had a good solid week. It was up 2.7%. Communication services up a little more than 1.5%. Financials 1.33%. Materials up about 1.33%. Technology up almost 1% for the week. And when you look across the board, I mean, yeah, energy's definitely gotten beaten up. Materials not as bad, but a little bit of downward action since we reached those highs a few months ago. But you look at the three aggressive groups, and there's communication services, all-time high on Friday at the close. Financials, new high on Friday at the close. Technology, I don't know if they made a new high, but it was right at the high. These are three of the significant aggressive areas of the market. When you've got the overall stock market moving to new highs and you've got the aggressive areas moving to new highs, that is a great combination, a very bullish combination. That is what history tells us. That's not what I'm just coming up with because it worked last week or it worked 6 months ago. Historically, when the aggressive groups are leading the market to the upside, that is very sustainable. And so when I'm looking at the market, I'm looking at history, that was the point of all this whole discussion, is that I think it's more important that you pay attention to what actually is going on in the market and what the signals in the market are telling us, not necessarily, what history tells us happens sometimes. If you look back at the month of September, I think over the last 71 years, I think it's the S&P 500 has gone up 33 times during the month of September, and it's gone down 38 times. So it's not like it's gone up 3 times and down 68 times. It's gone up 33 and it's gone down 38. Now, it's the only month of the calendar year, the only calendar month of the year, that we've seen negative monthly action more often than positive. September's the only month where we've had more down months than up months over the last 71 years since 1950. But it's not a slam dunk to go down. It's a month we definitely want to be cautious. And if we see other warning signs, I wrote an article it was almost a year ago, and I can probably pick it up. I can show you real quick. Because every once in a while, someone will say, well, you're a perma bull. You never write anything bearish. You're always bullish the market. That is mostly the case because the market's mostly higher. So, I view that as a badge of honor, a compliment. It's hard to stay bullish in the market when all you're hearing is bad news all the time. But if you go into my Trading Places blog, and you can hit this blog archives and you go back to September of 2020, a year ago, and you go down right here, September 3rd of last year, I said we had warning signs, significant warning signs in our sentiment indicators, which we don't have right now. So as we were topping, I was writing what I think was a pretty bearish article. And if you go over here and pull up the S&P 500, and let's just go back a year and 6 months so you can kind of see the action that was taking place up till September 3rd. Here's September 3rd. Actually, I think the high was on the 2nd. I think that red candle was the 3rd. Yeah. So there was the September 3rd. And I believe I published my article in the morning before this actually hit to the downside. But I mean, we were at a high and I was writing a bearish article. If I see what's bearish, I will write about what's bearish. But I let the charts do the talking. I don't let the media tell me whether to be bearish or bullish. And I know, there's a lot of folks that use a lot of the breadth indicators, and I find that the breadth indicators take me out of good markets too often because they're always flashing. And one thing you have to understand too is when you've gone through a crash, which is essentially what we did with the pandemic, we did the same thing, over an extended period of time, but we did it in 2008. We did a little bit with 2018, with the trade war, fourth quarter of 2018. We did it in 1987 with the crash. Different periods back in 2000, 2002 in the dot-com era. But when you go through these steep declines, one of the things you just have to understand is the way the market rebounds. And when the market rebounds, you're going to see very, very high percentages of growth in the market over short periods of time. It's because you had such a bad period before. If you look at June of last year and you look back to March of last year, 2020, and you see we went from 2,200 to 3,400. Now, some people will look at this and say, well, the market's gone up too much. It's up 1,200 points in 3 months. It's up more than 50% in 3 months. That's too much. And ordinarily, I would say, yes, that, anytime you go up 50% in 3 months, that's a lot. But if you're looking at it like that, you're simply ignoring the rest of what happened, which was this huge crash that shouldn't have happened. So what did we do over the 4-month period? We did nothing. But this 3-month period makes it look like we did a lot. And the point I make here is look at the PPO. The PPO back in June of last year jumped on a daily basis to over 3%, which is something we don't see a whole lot. And when you look over at every one of the rest of these highs for the rest of the year, the PPO never went up to 3 again. So does that mean that every one of these highs came with a negative divergence? No. I mean, that negative divergence, that's not a negative divergence. I could show you a chart and go back to 1999 and 2000. Remember when the NASDAQ went up from 2,700 to 5,200 in less than 6 months? I mean, I could tell you the PPO. Well, rather than just tell you about it, let's pull it up here. All right, we're going to go back and let's go 25 years. Now, don't worry about the individual data. Look at where the PPO was. So here's that big move I was just talking about, 2,700 to 5,200 that we made in less than 6 months. I think it was October to March. And during this period, first of all, right up here at the top, we reached a PPO, daily PPO above 5. And I could turn this into a weekly. The weekly went up above 10. Now, every high that we've made since we broke out on the NASDAQ back in 2015, every high we've made since then, the PPO has been less than that, 12 or 13. So should we be drawing lines here saying that we have a negative divergence? We would have missed the entire move to the upside. So you have to understand that every indicator has limitations. And it's why I don't look at lines on a chart and just start making these bold forecasts about what's going to happen to the overall market. And I think sometimes when you look at these breadth indicators, you have to understand that when you have a huge move like we've had over the last year, the 20-day, the 50-day, and even the 200-day, which is not on here. But the 200-day is also starting to turn really fast to the upside. So as more and more areas during this bull market rotate and see these corrections, more and more companies are failing to hold on to these moving averages. And so even though we're in a really, what I consider to be a raging secular bull market to the upside, breadth indicators are showing weakness because not all areas are performing. Many of these other areas are not breaking down. It's because we've had such a steep advance that their 50 and 200 days are rallying much faster than normal. And the severe, I'm going to call them severe periods of consolidation, because normally a period of consolidation, you might see, 3-5% on some of these stocks. Some are consolidating in, 20 and 30% pullbacks before they're then coming back and moving higher. You have to understand all that, or you don't realize what's taking place in these breadth indicators. And I don't want to sit back and try to make excuses to always be bullish and say, well, you just have to ignore these other indicators. But there's a fine line too, because there are times when you do have to recognize that the period that we've been in that's created the incredible breadth to the upside is unsustainable. We got to go through periods where we see this rotation. We've got to go through periods where the breadth isn't quite as strong as it was. And I think that's what's throwing a lot of folks off, is everyone's looking for the market to completely run out of steam. And I don't think it's going to happen. I think we've got more issues ahead when we've got comps to look at from 2021 versus 2022. I think that could be a problem for the market, because that's going to start translating into growth, into projections. What's the company's earnings growth going to be over the next 5 years? Right now, we've got these numbers that are just spiraling higher. And I think next year, if we start to see comps be a little troublesome, I think some of those, we may be a little high on some of the estimates, is what I'm getting at. So I wouldn't be surprised next year if we see some pullback. But this year, I think we're going to rally right into the end of the year. I said S&P at the end of this year, and this was back at the end of last year when we had our market vision event back in January. I said 4,700 on the S&P 500. It was 3,750 at the time. And that was coming out of the pandemic. We'd already come up, from 2,190 to 3,700. And of course, I was getting all that, oh, you're just a perma bull. Well, we're at 4,500 now. We still got 4 months to go. I mean, I think we're going to get to 4,700. I think there's a chance we could hit 5,000 before the end of this year. I really do. I think come fourth quarter, I think what's going to change between now and the end of the fourth quarter is that everyone's going to realize inflation is not a problem. And those who are sitting out or who've been getting into bonds, or actually probably not getting into bonds, not with inflation if they're worried about inflation, but those who maybe are just sitting on the sidelines, I think they're going to be back in. Anybody who's worried about inflation, I think, is going to be surprised, because I really think that this bubble that's going through the supply chain, we had a supply chain issue. We had demand that actually the bubble, if anything, was originally in the demand side as things started picking up. But now it's moved over to the supply side. Now everybody's trying to ramp up production to try and keep up with the demand. Well, when demand naturally slows again at some point, which it's going to do probably in the next 3 to 6 months, that's going to all of a sudden leave us a bubble in supply. And that's what worries me a little bit going forward. And that is what's going to be a problem. How are you going to have inflation when everybody builds all these things that we need and has all this supply, and then the demand slows down? Where's the inflation coming from? I just don't see it. I think this was a temporary blip, just like the Fed said. I think they nailed this one. And I think it will come out over the next 3 to 6 months that they nailed it, which in turn is going to give the market a lot more confidence in the Fed. And to be honest, as somebody who looks at the market and realizes how impacted the market is by the Fed, having confidence in the Fed really makes me feel good about the stock market. Anyhow, all right, let's keep moving. I know I'm rambling today a little bit, probably so excited about being able to be back here with you all. I don't know, it's got me just going all over the place. Anyway, the 10-year Treasury yield, let's take a look here, because we do have a couple other things I want to look at today. Let's get an update and see where we are. We were down a little bit. Yeah, we're still down a little bit, half of 1 basis point. But you can see we're starting to roll back over. From a economic perspective, we have July pending home sales out later this morning. Expectation there is for a rise of 0.3%. June, we lost 1.9%. So definitely looking for a reversal there in pending home sales. Later this week, though, we have got a ton of reports out. Tuesday, Case-Shiller home price, the FHFA house price index, also Chicago PMI, consumer confidence. That's all just tomorrow. Wednesday, we got our employment reports coming back out again this week. So we got the ADP employment report, PMI manufacturing, ISM manufacturing, construction spending. Thursday, of course, initial jobless claims, and then Q2 productivity, factory orders. And then on Friday, non-farm payrolls, expecting 740,000 jobs, 943,000 was last month. So we're looking for that to come back down a little bit, but we're expecting the unemployment rate to drop from 5.4% to 5.2%. And this is a key number. The unemployment rate, the Fed has talked about wanting to return back to full employment before tapering. That's one of the things they're looking at. So it is expected to drop 5.4% to 5.2%, but keep an eye on that, because as that keeps moving in the right direction, that's when we're going to see more and more of this tapering discussion anyway. Also on Friday, PMI composite and ISM services. All right, so let's talk a little bit more about what's going on with interest rates, because this is why this is how I came up with my call last week. We saw the US dollar break out above the March high to its highest level in 2021. And when I see the dollar going up, that makes me think, get the heck away from energy and materials. So that was basically the call, but this alone is not the call. You can see we did pull back in the dollar, and that's what gave energy and materials at least a 1 week reprieve. But it's not just the dollar. It's what's going on in interest rates here in the US versus Germany. And I show this chart a lot, but we're still in an uptrend. We did pull back last week. This is a weekly chart. And if you look closely at this, you can see right in here, we pulled back, rolled over just a bit. But I still think the big picture is looking higher. As a result of that pulling back, you can see the US dollar pulled back. But the US dollar, I think, still, to me, looks like it's trying to trend higher, even though last week we were lower. So this is kind of the big picture, what I would keep an eye on. If I'm going to be wrong about energy materials, it is most likely because I am wrong about what the yield is doing here, which means if you follow this chart and this starts to really drop, then you've got a pretty good chance to make some good money, both on an absolute basis and on a relative basis with energy and materials. But if I'm right, and that pullback in yields last week was a little blip, and when then we start to turn back up on a relative basis versus Germany, then I think we're going to see that dollar continue to move up. And as a result, energy and materials underperform. So just wanted to give you a little history there for those that may have missed that from last week. I'm sticking to the call. I mean, yeah, timing with the stock market, you make 100 calls, you're going to, you're invariably going to get at least 40 wrong. That's just the nature of technical analysis. I mean, this is not none of this is a certainty. All right, got my first tickle of the morning, the throat. Hold on 1 second. All right, I think I'm good to go to finish here. I knew that was coming at some point. So let's take a look at the relative strength here. Energy versus the S&P 500. So this is just the last 3 years. I can promise you the last 9 years we've been going down. So here was what I consider to be the really good period in energy, which was November through February. That's ended. I mean, we've been trending lower since beginning of March. I mean, if you didn't realize it, just looking at the absolute chart, you saw energy going to new highs in June. It didn't go to new relative highs, just to new absolute highs. So the secular bull market is lifting energy, but energy is not lifting the secular bull market. It's the other way around. So the last couple of months, you can see what's been going on in energy on a relative basis. And that is because we are seeing the dollar rising. The dollar rising typically leads to energy underperforming. Same thing with materials. Now, materials were much stronger and clearly in an uptrend on a relative basis. And that was for more than a year, from March of 2020 to early May of 2021. But when everybody was talking hyperinflation, remember back in early May, that's when the inflation reports were coming out crazy. Guess what? A lot of the good news was already built into material stocks. That's the way the stock market works, unfortunately. And so when the worst of the news started hitting, that was the top of the market for materials on a relative basis. Now, on an absolute basis, you don't really notice it that much. We've been consolidating. But if you're watching the S&P 500 go up and you're owning material stocks, you're underperforming. And this has been a problem for the past 6 to 9 months, I'm going to say. You get leaders in the market and you start to rely on them, you get into them, and then they underperform. And that's been a problem with trying to outperform the S&P 500. That's been one problem. Another problem has been the largest of the large cap stocks have been leading this advance. So if you look recently, Apple, Microsoft, Google, Tesla, those companies have, and Facebook, those five are five of the largest stocks in the market. So their capitalization, their market caps dominate. And as a result, when they're doing well, the overall market will do well. Well, if you've got a diversified portfolio, more diversified than the SPDR or the QQQ, you're going to struggle because most companies did not do as well as those five companies. And that's important to understand. You've got to understand the dynamics of the market, whether you're underperforming or outperforming. If you're outperforming the market, you've either gotten lucky on a couple of stocks or you have been in these big, large cap companies. If you're underperforming, chances are your companies have just been rotated out of, like most areas of the market. All right. What else do we have here? Tell you what, I'm going to go over to the relative strength industry groups, and I'm going to go to the view all. I know it's just after 9:30. We're going to wrap up here shortly. I'm so excited to be back. I can't remember the last time I missed 2 days. I missed Wednesday and Thursday show of last week. Maybe I took a couple of days off on a vacation, but I don't remember being off 2 days in a row being sick. But anyhow, here is the 104 industry groups, and you can see what's leading already today, by the way. Here's materials, 2 materials groups. I don't even have to look. I can tell you materials. And one of them is aluminum, which I said, look out, get out of the way of. I'm looking, there's the other one, steel down here. So both are performing well again today. Semiconductors doing well. Autos, good today as well. Anyhow, what I wanted to do is just show you like on a 1 week. I mean, I like doing this just to kind of get a sense of, okay, what's really been working over the last week. And I get a sense not only by looking at the industry group over here, but I also deliberately in each one of these, I have the sector. So I don't have to look at these and try and figure out, okay, which industry group is that? Which sector was that in? I can quickly look and just say, okay, here's a couple of material stocks. Here's a couple of energy stocks. Oh, energy and materials over the last week did pretty well. And I can do the same thing for the month. If I want to see what's been working over the last month, take a look. And then you can go back even further if you want. Normally the last month I pay attention to, but it's not just what's been working, but also what's not been working. So you just flip it, hitting that percentage change column. And you can see, okay, a couple of materials groups over the last month not working out very well. Consumer discretionary, 1, 2, 3, 4 in the top 10, not working well, okay? It just gives you a little bit more of a sense. It does me anyway. When I'm trying to look big picture at the market, and I'm looking for areas that I either want to consider or I want to consider staying away from, like for instance, brewers. All right, so over the last month, it's underperformed the S&P by 11.48%. If I click on that, I can quickly look. You look at the relative weakness. This isn't the absolute weakness. This is the relative weakness. Brewers divided by the S&P 500. So this is simply a ratio chart. But look at how badly. Now, if you owned a brewery or a brewer in your portfolio, and you're underperforming, you can probably bet that has something to do with it because the brewer's not doing well. Look at the absolute chart. How many areas of the market have lost a third of their market cap in the last 6 months? Not too many, not in this bull market. Brewers have. So that shows you quickly how the worst area of the market is performing. So I use it for a lot of different reasons. All right. Let me get out of that. And so let's go ahead and move on. I want to go over just a couple of, actually, that's going to be that's not what I want to do just yet. I wanted to show earnings. I thought I had something already set up, but I guess not. Well, I can tell you that there really weren't a whole lot of earnings out this morning of significance. In terms of market cap, I think this is an auto company, Li Auto. So it's already traded 1 million shares. It's down 2.29%. They reported this morning. I did not see results. I think Catalent, CTLT also reported this morning, or at least were scheduled to report this morning. These are companies scheduled to report. Cloudera was supposed to report this morning. I was very interested to see how that, that's right, they got bought. Never mind. So let's talk about companies that will be reporting this week. So tonight, or today, after the bell, there's a big one. We got Zoom. Zoom is reporting. Zoom is up $4 today. On a relative basis, however, if we look at the relative chart, I'll be honest, I love the company, but this company relative to its peers, not been very strong. And this is what I typically use as kind of a forecasting model, if you will, of what to expect from an earnings report. And the reason I use this is Wall Street basically is placing its bets. So Wall Street goes out, meets with these management teams, all these various companies. They hear before the end of the quarter. There's a quiet period that companies go through. So you can't talk to companies' management after their quarter ends until they've reported. So all of these discussions would take place prior to the end of the quarter. So Zoom through the end of July could talk, to Wall Street. And through the end of July, I'm not seeing Wall Street overly excited. I don't see money pouring into Zoom relative to its peers. And so that just tells me Wall Street is not overly impressed. Think about NVIDIA, which came out with a great report, or any AMD, any of these companies that came out with big reports, saw huge moves up into earnings. Wall Street was accumulating. We're not really seeing that on Zoom. So I'm a little nervous about the report today. Remember, they just bought Five9, FIVN, recently, last couple of months. And so they're going to have some costs associated with that. I don't know what the culture is going to be like, the two companies coming together. Maybe Wall Street's a little concerned about that in the near term. But whatever the reason is, I'm a little nervous about Zoom going into the report today. I do own some shares. I don't know what I'm going to do. I'm absolutely going to be selling some of them before the open or before the close. I don't know if I'm selling all of them or not. I don't know if I want to take a risk. I can tell you another company that was similar to this last week that I owned. I was trading and I got out before earnings, thank goodness, was Peloton. And look at Peloton on a relative basis to its recreational products peers. Horrible, just horrible relative action. Wall Street not really liking what it was seeing. And what happened? Big sell-off. Now, that doesn't guarantee what we're going to see with Zoom. Zoom could do anything. Zoom could be up 100 after the bell. They could blow out the numbers. I think sometimes it comes down to the management teams, how much they want to share. Normally, when you have good news, you want to share it. Normally, when you have bad news, that's what you really don't want to share. Who wants to share bad news? So I'll be surprised if Zoom has that kind of a move to the upside. But literally going into earnings, anything goes. You should never, ever go into an earnings report feeling 100% comfortable. What's going to happen, because that's probably going to be the time where it's going to be opposite of what you're thinking. So anyway, those are just a couple. So Zoom reports after the bell today. That's a big one. A couple of other companies reporting after the bell later this week. Actually, I don't know for sure all of these are after the bell, but big reports coming up later in the week. Tuesday, CrowdStrike. Look at this company breaking out. Look at the big volume push to the upside. So I would expect better results there. Then you've got NetEase, not looking very good there. And I would be looking again down here at this relative strength. Look at NetEase relative to the internet stocks. Don't expect big numbers there. Anaplan, which is a software company, PVH. Wednesday, we've got Viva, which is in the software space. This one also, mostly in a downtrend. I don't know. This one I'm a little nervous, especially it's coming up into its earnings. I don't know if that's going to be a head fake. I'd be a little careful here. Then we got Chewy reporting on Wednesday. Another one, just kind of blah versus the specialty retail group. OKTA, another really previously strong software stock, was at a 52-week low a week ago. So is this move to the upside kind of a little final last hurrah before another disappointing report? Or is all this sideways consolidation after something to really jumpstart the company again? I don't know. Wall Street doesn't seem to be too impressed heading in. Thursday, we've got AVGO, and I know I'm way late today getting the show done. I'm sorry. But AVGO breaking out ahead of its earnings report later this week, but on a relative basis, not really doing that much versus semiconductor. So it's almost like semiconductor, the whole group is dragging Broadcom higher. One other I'll report, though, DocuSign, which is in our portfolios, will be reporting. AD line looks very strong there, and we've seen very good, solid relative strength coming off of that 52-week low back in May. So this is one that I would actually look for some better numbers from this quarter coming up. Okay, last three you must see, and then we'll wrap up. We'll do these real quick. These three were the worst scooter movers in the large cap, mid cap, and small cap arenas from last week. So this was VMware, which had a huge recovery. They had reported gap down, looked like it was breaking down, and actually came through and held. Let's see what happened here today, or what is happening. Yeah, stock's doing all right, up a little bit more today. I would say, if it can get back up above about 150, it may have put in a really nice little bottom here. But I'd like to see it get back through the high from Friday. And then SAVA, this is the mid-cap worst performer from last week, from Friday. I don't like this breakdown. This is a company that had gone up a lot. It's extremely volatile, number one. So you've got to be incredibly, you got to be able to take on a tremendous amount of risk to even consider trading a stock like this. I mean, it was 120 or 130 4 trading days ago, and now it's 52. You'd think maybe you'll get a bounce, but I don't know. I'd stay away. PDEX, the worst among the small caps last Friday. This big move down, also breaking below key support. Not going to be a fan there. All right, that is it. Again, appreciate everybody, your patience last week. I'm really thankful to be back here today doing this and looking at the market again all day, which would be nice. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for the recorded version of Trading Places Live. You can access that from Stock Charts. Just click on this Stock Charts TV right around 9 o'clock. Show will start at 9 a.m. And I'd love to have you join me for that. So everybody have a great day today. I'll get that daily market report out. No problem today. And also just want to let members know we did update the strong earnings chart list, the strong future earnings chart list, and hopefully later today, I'll have that raised guidance chart list for you as well. If they're not already updated on the site, they should be shortly. And I'll keep you posted on that in the daily market report. Everybody have a great day and happy trading.